Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So let's take a look at the CDD, for example. While we know the CDD is sitting down right now, ultimately below that 95 level, but that being said, we may believe that that 95 level is a key support level and should act as such for the next month. At the same time, rather than having a put option sold, which has an unidentifiable risk exposure. And just to give you an example, just to kind of backtrack on the slide here a little bit, if we just sold that 95 strike put option and all of a sudden we see the pair value down at 90, let's say, well, even though we collected a couple of, even though we might have collected, let's say 75 cents for that put, we would be responsible for the difference between 95 and 90, which means we'd be responsible for $5. Not a good proposition. Whereas if we buy the put option at 94, we're really only responsible for the difference between the two strikes. So the premium that we get to collect is the difference between our long, the premium collected minus the cost of the lower put, and our maximum risk is the difference between the spread minus the credit. So if we look at the mathematics, at the time when I was doing this, CDD was sitting around 95.50. We were going to sell one August 95 strike put, and we were going to collect 54 cents. Now remember, we can typically sell at the bid price. So that's where we're going to get the credit. We're then going to buy one August 94 strike put, and that's going to take 28 out of the 54 cents out of our account. Now, the net credit that we're going to receive here is 26 cents, or $26 per contract. Now, remember that we're going to have a capital requirement because we're responsible for the difference between our 95 strike and our 94 strike. So that means that the difference is $1, or 1 point, we'll say. Now, if the credit we receive is 26 cents or 0.26, that is ours to keep, which means no matter what happens, we're going to get to keep the 26 cents. But if the underlying pair drops below that 94 strike, we're still responsible for the difference between the dollar minus the credit received, which means our capital requirement is $74, or is $74 per contract. Now, potential profit is 26 cents. Risk is 74. Return on risk is 35%. So we have to look at this strategy, the credit spread, differently than looking at the actual debit spread. Because in a debit spread, I said you want to have a position where where you can profit at least 100% on your initial capital outlay, but you're never going to get that in the credit spread. So what we want to look for is we want to, more importantly, look for probabilities of options expiration. And so even though we're having to put up 74 cents in collateral here, and our risk is 74, we want to recognize that we've now put time depreciation on our side, which means that for that benefit, and for the benefit of really creating a passive position and the possibility of generating 35% on our risk capital, we're going to have to incur a little bit more of a risk tolerance in order to do so. Now the thing is, if we wanted to be more conservative, we would simply write a further out of the money option contract. So we might decide to write 94s and buy the 93s. And that ultimately will probably collect us less premium, but give us a higher probability that those options are going to expire worthless. So in this case, when we look at the risk graph, our maximum profit potential is $26 per contract. Our maximum loss is 74, and our break-even point is the 95 strike minus the 26 credit, which means that if the pair value is trading anywhere above 94.74 on expiration, well, we're going to make a little bit of money. Anything below that is where we start to incur our losses. Now, if we're bearish on a particular pair, well, we can sell off some call options. And again, first and foremost, we want to be bearish on the pair. We're going to look to sell the call option at a strike price above the current pair value. Now, as I said, what I like to look for is I like to look for, in this case, resistance levels. In the case of the put spread, the bull put spread, I want to look for support levels, sell puts below support levels. In the case of the call spread, I want to look for resistance levels and sell options above resistance levels. So here we're going to sell the call option at a strike price above the current pair value and receive a credit. We're going to then purchase the call options above that sold strike price to limit our potential losses. That cost is subtracted from the credit we received. As long as the pair value stays the same or drops in value, we receive a credit. Now, I looked at the AUX, the US versus the Australian dollar, as an example. And my outlook was here, again, just as an example, is that we may feel that the AUX is going to stay below 96. And we may believe this because of a current resistance level that is being established. So we want to sell those calls off above that strike, and we want to buy the strike price above that in order to mitigate our risk exposure. So in order to determine how much credit we're going to make, what cash flow we're going to receive, we need to take the higher strike call premium and subtract it from the collected premium to come up with that number. The risk is then looking at the difference between the strikes minus the credit. So in this case, looking at the AUX being at 94, we're looking at selling off 1 August 96 strike call option and collecting 75 cents. We're then going to go in, we're going to buy a 97 strike call, and it's going to cost us 63 cents. Now, again, if we wanted to secure a higher credit, we could go to the 98 strike calls, and of course that's going to cost us less to buy because it's further out of the money, but our risk exposure is going to be greater because now we're going to be responsible for the difference between 96 and 98. So the further out we buy that protective call, the more credit we'll keep, but the more risk we assume on the position if we're wrong. Now, in this case, the net credit is 12 cents or $12. So when we calculate that out, the difference between the strike prices is 1 point. The credit that we received is 12 cents or 0.12 of a point. We take 1 point minus 0.12, and we have a capital requirement of 88 cents or $88 per contract. So our profit potential is 12. Our risk is 0.88. And our return on risk is 14%. So in this particular scenario, in this particular example, our risk reward is not that great. But again, if we're looking at it based on a percentage rate of return, all the underlying pair has to do is just stay above the 96 strike, or sorry, stay below the 96 strike, and we're going to capitalize on that 14% rate of return. So the idea is that we can create these particular credit spreads across a variety of different pair values and ultimately look to collect the premium on a month-to-month basis. And as long as we're conservative about which options we write, and we try to write the option contracts that look like they have a high probability of expiring, then we're going to be able to generate that cash flow on a month-over-month basis. Now, the other little secret I'll share with you guys here is I'm just going to go back to my price charts. Bear with me here while I get back to my price charts. Sorry for backtracking here. But if we also believed that the pair was going to stay below, and in this case I'll use let me just use a line to illustrate this. if we felt that the pair was going to stay above, and it's kind of hard to see with the yellow, but above above 92, then what we could do is we could sell off the 92 strike puts and buy the 91s. And what we've created is a bear call spread on the upside. We've created a bull put on the downside, and combined, that strategy is known as an iron condor. So an iron condor is simply looking at a particular pair value, selling off a call credit spread above a resistance, selling off a put credit spread below a support, and now you're collecting premium on both sides of the trade. And the main consideration is, as long as the pair is trading between the written strike puts and the written strike calls, hey, we collect premium on both sides of it. And the cool thing about it is that you can only be wrong on one side. So just food for thought when looking at establishing these trades when you're looking to play around with some of the ideas, is that don't be shy to create these iron condors, because quite simply put, an iron condor is just two credit spreads put together. So based on that note, let's just get back to taking a look at our risk graph. So you can see here that our risk graph reflects the maximum profit potential of the trade, which is sitting at $12 per contract. So if we did 10 contracts, we could make $120. The other rationale is that our risk exposure is $88 per contract, so therein lies that 24% rate of 14% rate of return. But remember, you're not going to just do one contract. You might do 10. You might do 20. So you may look at generating $200 to $500 in premium over on a month on just this one particular strategy. So again, just food for thought, guys. Our break-even point, to illustrate once again, is the 96 strike plus the 12-cent credit. Means that as long as the underlying pair is trading anywhere below 96.12 on the settlement date, or as long as it settles anywhere below that, we're going to at least collect some of the credit in order for it to be a profitable transaction. Anywhere below that, and we're incurring a loss. Okay, with the maximum loss happening as the pair trades below the written strike of the 97 strike call options. So guys, a couple of points to remember when creating these credit spreads. Near-term options expire faster. So if we're looking to generate cash flow on a month-over-month basis, we want to look at selling the near-term option contracts because they have a higher probability of expiring. And remember that the closer the strike price intervals, the less margin requirements. So in other words, a credit spread that has a strike interval, let's say of a 96 call to a 97 call, requires less capital than a credit spread that is created by using a 96 to a 98 strike call option. Now, the closer the written strike price to the current pair value price, the higher the premium we collect. So a lot of times these at-the-money option contracts become very attractive because you're collecting a lot of premium. But we have to recognize the reason why you're collecting a lot of premium is because there's a greater chance of the options expiring in the money. So if we want to put the odds in our favor, what we do is we go further out of the money, we collect less premium, but we have a higher probability of recognizing our full profits on that particular trade. And finally, again, the strategy is great for income generating. So just simply looking at utilizing these ISE FX option pair values to consistently generate cash flow on a month-over-month basis by identifying key support and resistance levels and selling those option contracts out of the money, creating that credit spread strategy to limit your capital requirements and mitigate your risk exposure, and just sitting back and letting those options expire. Now remember, if you feel that you're pressured in the position, if it's not going in your favor, just simply close it out at any time before expiration. Okay, you can close that position out anytime by simply buying the spread back, and it will alleviate you from any further risk. But ultimately, as long as the pair is trading, in the case of a call option right or below the written call, or in the case of the put option right or above the written put, you got nothing to worry about. So you can pop open your trading account, take a look at the pair value quote. As long as it's where it needs to be, you can close it up, and you can sit back and you can relax until the next day. So guys, just a reference to where you can find a lot of information, a lot more information on these pair values. You can take a look at fxoptions.com. A great resource, a phenomenal site actually. They've done a really, really, really good job at designing this site. Lots of phenomenal information, currency news and commentary. They've got a feature called FX Options TV where they've got a live analyst giving you insight on the state of the currency markets. There's podcasts, there's forums where you guys can kind of jump on board and chat with each other on your various thoughts and outlooks on the currency markets. And don't forget, guys, and I don't see it mentioned on here, but our FX Options Outlook, which optionsource.net produces every week for the ISE, and we're very proud to do so, where you can take a look at what our expectations from a technical standpoint is or are on the various pair values. We do the majors, we do the CDD, which is the U.S. versus Canadian dollar, EUI, which is U.S. versus euro. We do YUK, U.S. versus yen. We do BPX, which is U.S. dollar versus pound, and we do YUK, which is U.S. dollar versus a yen. So you can check that out. So with that in mind, guys, I'm going to wrap things up. And just a little shameless plug here. If you guys are interested in finding out more about what Option Source is all about, we invite you to hit the site, optionsource.net, and take a look at what it is that we do on a day-to-day basis. With that in mind, guys, always a pleasure. Katrina, thanks so much for having me back. We love to be working with you guys with these webinars, and it's great to be a part of the evolution of the FX options market. So I will wrap things up from here, and if anybody has any questions for me, you can certainly either type them in, or I can be reached at jason@optionsource.net. So with that in mind, guys, that's it for me. So enjoy the rest of your evening, the rest of your day, depending on where you are in the world. And Katrina, thanks again for everything. And we'll see you online hopefully very soon.
All right, great. Thanks so much, Jason, for sharing your insights today, as usual. Thanks to everyone for joining us as well. If you'd like to learn more about the ISE FX options that we've discussed today, please visit fxoptions.com. You'll be able to see the full list of available currency pairs, plus take advantage of all of the educational resources that we have available on there as well. We do hope to see you at our upcoming webinars. This webinar, as always, will be archived at ise.com/archives. It should be up there within a couple of days. If you want to sign up for any future webinars, make sure to visit ise.com/webinars. You'll be able to check out the latest schedule there. Thanks again to everyone for joining us tonight, and we will see you again next week. Take care. Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.